We are currently looking at a British pound US dollar 60-minute chart, and I wanted to show you a medium-term time frame in order to get an understanding as to where to look for levels of resistance and support and levels at which we could see a market reaction that will generate more than 10 pips plus spread. Now, we moved quite aggressively off this low of 94.40 all the way up to 97.20. And you see this previous high here. Look what price has done. It has moved through the high and it has come back to what was resistance, now becomes support. So what would you want to do at 97.20? You would want to buy it there. Just looking for a bounce. Just looking for a bounce here because this level may not hold. So we see a price bounce. So from the low to the high, 17.45. A 30 pip bounce, and you would want to take your profit out before this high here if possible, but we get a 30 pip bounce, then we get a rejection, and this is actually quite a nice, I like this type of rejection. It's a reversal for a medium-term type trade, a non-scalping type trade. It's a real nice, once price moved down here, now you start looking for your entry. And where would you look for your entry? Well, you'd look for it on the back of 97.20, okay? So we see 97.20 comes up and it rejects. Now this is a good scalping trade as well as a good medium-term trade. But you just want to catch the bounce off of here because it may just move in this range for a while before heading back up. Now that we've achieved a high, what you want to do is you want to pull your Fibonacci from this low to this high, because as price retraces, we want to start to look for the potential of the market to bounce at maybe some of these Fibonacci levels. And based on the reaction at these Fibonacci levels, we could scalp off of those levels. The other thing to observe in this chart is the average true range indicator that's at the bottom, and you'll see here how it moves in peaks and valleys. Now, this is an average true range set at a period of 5, so that means it is the average range over the last five hours. So each candlestick represents 1 hour, and each hour will have a range of, let's say, right here, let's say 30, 35, or 40, 45 pips. It'll take the average over the last 5 candles, or the last 5 periods. So the reason why it goes in peaks and valleys is because the market, typically the higher volume times, is going to generate more volatility or bigger ranges. So when Europe opens and London opens, we get a lot of volatility. Then during lunchtime, it slows down a little bit. Then when New York comes, it picks up a little bit. Then it slows down for several hours. Then when the Asian session opens, it picks up a little bit, but not much. So, but typically the lower volume periods are the Asian sessions. Okay. Now, the reason why this is important in our trading is because we need to get a reaction of 15, 20, 25 pips in order to get some profit. So the higher the volatility during that period, the better. Okay? Or the bigger the ranges of each candle, the higher the probability of us getting paid. Now, going back to our current price action, of course, you'd be watching these levels on a 15-minute or 5-minute time frame as well. So you'd want to sell it off 97.20, and here, the reaction that we get off of 97.20, the range of this candle alone is from 93 to 24, so it's 31 pips. Just the range of this one candle is 31 pips. That's why you want to trade at resistance and support, as we discussed in the resistance and support section. Now it continues to fall in this range, but now we want to stock where the market could bounce later on that day. Now we're at a 38% retracement, and we see that the market bounces at the 38% retracement. So the range of this candle alone goes from a low of 19 to a high of 44. So it's a 25 pip bounce just off of the 38% retracement and this level of resistance here. price comes down to the 62% retracement and responds from a low even just to the close, although it probably went higher, 57 to 80. So 23 pips from the low just to the close here. 23 pips. Of course, you're not going to get it right on, and you have to account for the spread. But a very strong reaction, and probably even went even higher off that price level. And let's have a look. And indeed, it does go higher. And this level of support is probably going to act as resistance, and we will probably get a reaction off this level here. So let's say that take this candle right here, widen that so you can see it a little bit better. The high to the low of this candle is 21 to 94. So again, just on this movement of this candle, the reaction off of that high alone has generated around 26 pips. Now, we watch for this level to hold. Okay, and that gives you an idea as to how price can respond to these levels. And we're actually up to the current day's price move at the moment, and but that gives you an idea as to how, as you're watching the intraday moves, to anticipate certain price bounces. Some days will give you more trades, and some days will give you, of course, much less. Furthermore, as you're watching these prices move, you want to watch the euro-dollar cross to see if there is a positive correlation between the two crosses in terms of its US dollar move, or whether there is some divergence between the two. So for example, the British pound may be moving, may be rallying against the US dollar, where the euro may be delayed in its reaction, and that can also help you to discern whether or not to accept a trade, whether to move into a trade at a certain time as they both come back into alignment.